So this video covers capital budgeting, and this particular one is for a new or an expansion project, not a replacement project. And the information for the project is actually on the same spreadsheet that I'm posting for the class, and it is over here on the side. So this is the one for household energy products. This goes with your CFIN book. And so you'll find also most of this information in the book. I've added a little bit of information in order to be able to kind of more accurately complete it. But in your book, this is on pages 168 to 171. So what we have are our cash flows broken down into three areas: initial cash flows, annual cash flows, and terminal cash flows. So we'll look at each one separately. So initial cash flows are going to include all equipment, which will include the shipping and installation on them, and then any increases in net working capital. There may be times also where you might actually have an investment in a building, but for this project, these are the two areas that you have. So the equipment is pretty easy to understand. If you look in the text or you look in the readings over to the side, you're going to see that they're going to spend $9.5 million on the equipment, and shipping and installation is $500,000. So we're just going to insert right up here that the equipment cost is $10 million, the two numbers netted together. And then we have net working capital. And again, this is given in our problem, and it says that net working capital will needed to be added in order to launch the project, and the amount of that is $4 million. Now that usually is going to represent additional investment, maybe in inventory or spare parts. It might also mean an increase in accounts receivable or even cash reserves. And these are always offset. So if you get a problem that also has some current liabilities, you would offset them because it is a net number. So if you were given that you're going to have to add $10 million in inventory, but it's going to be covered by $4 million in accounts payable, then your net would only be the difference, the $6 million. Here we're going to go with the net number that's given, which is $4 million. So your net investment in year zero are these two added together of $14 million. So typically we would enter these as a negative number in a spreadsheet for year zero. And then we have the annual numbers. So I'm going to go back over here to the text and just kind of point out a little bit of that to you. The problem here says that they are going to sell these devices, annual sales 15,000 units at $2,000 per unit. So we'll multiply those together to get the amount. They don't need any additional space. That's why we didn't have any building. This is the part about the equipment. It does say depreciation is using the maker's 5-year system. The project itself is going to last 4 years, so the equipment will not be fully depreciated at the end of the 4 years. The $4 million in net working capital comes back at the end of the project, so that'll be our third area, the terminal values. And it also says the equipment that you're purchasing for the $10 million is going to be sold for $2 million at the end of the project. Variable costs run 60% of the revenue. Fixed costs are $5 million a year, and the tax rate is 40%, and evaluation is at 12%. So when you put these numbers into your spreadsheet, we're going to put, for the 4 years, the units sold each year is 15,000. So you just want to put that in each of the 4 years or drag it across in Excel. And again, the problem said 2,000 was our selling price for the units, so we'll enter that as our price point. So our expected revenue or sales is going to be the 15,000 times the 2,000. So $30 million per year. So that's the same consistently across all 4 years. Again, variable costs are set at 60%. So variable costs are equal to 0.6 times the 30 million. 18 million. Per what it tells us in the vignette, in the story that's on here, $5 million per year is what's expected in fixed cost. So we just type that in. That's just a given number. And then we come to our other expense, which is depreciation, that we can write off. So depreciation we have to calculate. So I have made a spot over here for the 4 years, and I've looked up what percentage that you can take out each year for depreciation, what amount you can deduct. And so year 1 is 20%, then 32, 19, and finally 12%. So we're going to take that depreciation off. So we have 20% times the $2 million is $2 million in year 1. And then 32%, 19, and 12%. Whoops. Didn't do that right. Times, let's see, H15. So we can also at the same time calculate what the book value is each year. So after year 1, the book value is going to be the 10 million less the 2 million that we're taking off in depreciation. So less, and then the next year you would say that it would be equal to the book value the year before minus the depreciation in the current year. So minus the 3.2 million. And so at the end of year 3, your book value is down to 2.9, and at the end of year 4, it's down to 1.7 million. So you kind of have your book value calculated. So we go back over here, and we can use the miracle of the Excel sheet and say depreciation is equal to this number over here. It's equal to, right here, this 2 million. And hit enter. So you can either type those in, the ones you just calculated, or you can just tell it to read the spreadsheet across. So those are the exact same numbers that we just did, so they're right here. 2 million, 3.2, 1.9, and 1.2. So we have sales, variable cost, fixed cost. And then we're going to subtract all of those from the sales and come up with our earnings before taxes. So equals 30 million minus 18 minus 5 minus the 2 million, which is B20, and we come up with $5 million for year 1, and then pull it across, and this is our taxable income, our earnings before taxes. Taxes are 40%, so we take 0.4 times . So our taxes are calculated as 40% of the line above. We subtract off our taxes. And we get to our income. But we're not dealing with income, we're dealing with cash flow. So these are all of our expenses, but the one that isn't really a cash expense is the depreciation line. So we need to add back the depreciation we deducted here. It'd be easier if we didn't have to worry about it at all, since it goes in and then comes back out. But we do have to worry about it because it impacts the amount of taxes that you pay. So we're just going to add it back now. So depreciation right there. Pull it across. And now we're just going to do the addition to get our cash flow. So equals B23 plus B24. And we'll pull that across so that they're all adding up. And there we have the cash flow for the 4 years. So then we have the one more thing to consider here, and that is, what about when we close the project down? And per what we wrote, or what we read in the writing, it said that we would be able to get back our net working capital that we put into it. And we put into it $4 million. So in year 4, we would get back the $4 million. And the other thing that we would get is that we would sell that equipment that we bought. And again, if you go back and look at what it says that we bought it for $12 million and that we can sell it now for $2 million. So we'll go over here and we'll calculate off to the side then what's our cash inflow. Now it'd be nice if we just got to keep the $2 million, but it depends on whether or not we had a loss or a gain on the sale based on the book value. We're going to have a tax consequence. So we have the selling price, or the sale of the equipment, and that's $2 million. And then we compare that with the book value. So if you recall, I had the book value up above, and our current book value now is $1.7 million. That's how much is left after we write off all of our accumulated depreciation. So we'll insert the $1.7 million here, and we subtract to figure out whether we have a gain or a loss. And obviously we have a gain because we're selling it for more than we're on the books for. So the $2 million minus the book value, and we have a gain of $300,000. That's taxable, so tax is at 40%. So we do the 0.40 times the gain, and so we owe taxes of $120,000. So our net cash flow is equal to the $2 million, because that's the money that's coming in, less the amount of taxes that we owe, so minus I-23, and we have a net cash flow of $1,880,000. So take it back over here, and under our terminal values, I have $1,880,000. So in year 4, not only do I have the regular annual cash flows, but I add to that the $5.88 million. So then if I wanted to evaluate, year 0 is going to be equal to a negative of the $14 million investment. So I'm putting equals, and then I'm going to put a negative sign in my calculation area, 14 million, or you can just type it in, but that's how much you put into the project. And then these numbers are just coming from right up here, and then the year 4 number is going to be both what you get in year 4 in your annual operations plus the terminal money that's coming in. And then you can evaluate it with all the normal methods like net present values. So it would be, and I'm using a cost of capital again at 12%. So equals the MPV, the rate. I'm going to click this box, the 12%, or you can type 0.12, comma, and then I'm going to come back over here and I'm going to grab years 1 through 4. Do not include year 0. That will mess up the calculation for discounting. So you just want to select years 1 through 4, close your parentheses, hit a plus, and then add in your negative 14 million. So click over here. So this is what it looks like now. Hit OK, and we have a positive net present value of $5 million and some change. Do an internal rate of return equals IRR, open a parentheses, and do years 1 through 4. I'm sorry, 0 through 4. Include year 0. So close your parentheses, hit OK, or hit return, and we find an internal rate of return of 26.32%. And that's how we put together a new or expansion project and determine the net present value and internal rate of return.